Hi friends, based on market capitalization, SEBI classified equity mutual funds into 5 types. Present video is about small cap equity mutual funds. On market capitalization topic, I made a separate video. Link is available in the description box. According to market capitalization, SEBI classified public limited companies into 3 categories: large cap category, mid cap category, small cap category. First 100 companies with the highest market capitalization come under large cap category. These companies are well established, reputed and had been in the market for a long period. They are the branded companies and most of the Indians use their products daily. These companies are generally the leaders in their field of business. The shares which are sold by these companies are known as blue chip stocks. Second one, mid cap category. Mid cap companies are those which are ranked between 101 to 250 in the list of companies according to market capitalization. Third one is small cap category. These are young and smaller sized companies. 251 and above placed companies based on market capitalization come under this category. Now come to our present topic, that is small cap equity mutual funds. For example, one AMC asset management company launched a small cap equity mutual fund scheme, and the company is able to collect 50 crore corpus from 10,000 investors. Now the fund manager of AMC should invest maximum portion of this corpus, that is minimum 65% in small cap company stocks. Remaining 35% he may invest either in large cap company stocks, mid cap company stocks or in both. Otherwise, he may invest total corpus in small cap company stocks. Then that fund is known as small cap equity mutual fund. So what do you mean by small cap fund? If maximum portion of corpus is invested by the fund manager of AMC in the stocks of small cap companies, then that fund is known as small cap equity mutual fund. Now let us see some important points related with these funds. First point is, risk is greater with small cap funds than with large cap and mid cap funds. Reason is, this fund portfolio contains small companies which are totally new to the market. So the stocks of these companies are more volatile than large cap and mid cap stocks. Even the slightest volatility in the market conditions can have huge impact on share prices of small cap companies. The NAV, net asset value of these funds, is highly sensitive to market movements. When market slumps, these funds are the worst affected. Therefore, when market conditions are not favorable, there is a risk of losing a huge amount of investment in case of small cap equity mutual funds. So, these funds are suitable to whom? An investor who is ready to take risk. Now the second point is, when market is high, these funds tend to offer great returns than the large cap and mid cap funds. You know, NAV of these mutual fund units is highly sensitive to market conditions, and the portfolio contains small companies, no? And this small company has a lot of scope for development. When market is good, these companies expand aggressively. As a result of that, market price of these company shares increase dramatically. When market price increases, then NAV of these mutual fund units also increases. Thus, these funds tend to offer great returns than the large cap and mid cap funds. The next point is about liquidity. These funds have a poor liquidity because they are totally new to the market. Nobody knows about these companies. Therefore, if you want to purchase or if you want to sell your mutual fund units, it is very difficult to find the investor. Then last one is suitable for whom. First point is already completed. Come to second point. Small cap mutual funds are suitable to individual investors over institutional investors. Institutional investor means these are the organizations which pool public money for investment purpose. For example, banks, insurance companies, pension funds, they prefer to invest in large cap company stocks because institutional investors need safety for their principal amount because it is not their own money, public money. As they are answerable to public, they need safety of investment and regular returns. So these funds are suitable to individual investors who are ready to take aggressive risk. Now come to the last point. Stay invested for a long period. These funds are suitable to the investors who want to stay invested for a long period. Avoiding investment in these funds by keeping risk factor in mind is not a wise decision. And some investors, even though they are interested in these funds, they prefer to invest for a short period, which is again a wrong decision because the stocks of these companies are highly sensitive to market conditions. So in short period, you cannot expect much returns from these funds. They give better results in long period. So you have to be patient while investing in these funds. As an investor, you should give some sufficient time to your investment to generate returns for you. The recommended time frame is 8 to 10 years. It is advisable to invest small amount in these funds and stay invested for a long period to boost your wealth. So finally remember, small cap equity mutual funds are suitable to individual investors who are ready to take aggressive risk, and it is advisable to invest a small amount in these funds and stay invested for 8 to 10 years. I hope you got a complete approach about small cap equity mutual funds. Thank you.